Boris, thank you so much for being here with us today. We always want to give students an alternative look, an alternative view, especially when it comes to finance and more importantly on the analytics side. So I'll give you a quick background for those of you that hadn't had a chance to read his bio on the invitation. Mr. Akio is a partner of Ares Credit Group and a portfolio manager and co-head of Global Liquid Credit. He serves as a member of the Ares Credit Group's European Liquid Credit and European Direct Lending Investment Committees, as well as a member of the Global Asset Allocation Committee. Prior to joining Ares in 2016, Mr. Akio was a managing director and head of capital markets for global market securities at the Carlyle Group. I think the name some of you might be familiar with, where he focused on sourcing credit investment opportunities from banks, sponsors, syndicating excess risk, and developing new business opportunities. Previously, Mr. Okuliar was head of leverage capital markets for UBS, where he focused on structuring and market execution of leveraged loans, bridge financing, and high-yield bond placements. Mr. Okuliar holds a BSBA from Georgetown University with a double major in finance and international business, and he's a graduate of the Advanced Management program at Harvard Business School. Boris, thanks so much again for joining us. I'll let you take it away and I'll kind of MC in the background for you, all right?
Well, thank you very much, Matt. And as I said previously to Greg, it's certainly a pleasure to be here with everyone. And it's always an honor to get to spend some time with folks that are getting themselves up the curve and more importantly, looking to better themselves and find the right opportunities to not only succeed personally, but professionally, and contribute to things that are happening around us in the world. And I think that the business environment has a lot of opportunity to give back to the community as well. So putting all those things together and putting your future first is something that is going to be beneficial to everybody. And it's a great thing to see here. With that, I don't know if it would be best, Matt, for me just to lead in with a little bit of background and talk about kind of how I started out.
That would be great, Boris.
Excellent. So as I think that you can probably tell, there's still a slight ring of accent to my tone, but I grew up in the upstate South Carolina in Spartanburg, where I spent my formative years before going on to Georgetown University. It was a little bit of a different background, as I always like to recall my parents, and in giving me this name, I think it's pretty obvious that they also hail from a different origin. And they came over from the former Czechoslovakia and the former Yugoslavia, getting away from some of the similar things that are happening in the world today to find a better life for themselves. And I was left with an interesting name, and I showed up at my first day of school, which I think some folks on the line might remember, without speaking a word of English. So that was quite a way to start. But what it did do, I think, for all of us within the family, as well as that as a beginning, was teach me how to keep an open mind and think about what the different opportunities are in front of me, and learn to adapt to situations and try to take the best from what I saw in front of me. So the scope was definitely wider, as we didn't really have any sort of a safety net or family to rely on. We just tended to rely on each other and the community around us. And it was excellent because the community was certainly welcoming over time, and they're still some of my deepest and closest relationships to date. So still have a very fond connection, and that's where I'm sitting in my parents' house in Spartanburg right now, delivering this conversation. But from that perspective, though, and coming from a different place, I think that the scope, as I mentioned before, was a little bit wider. And so as I was thinking about my next opportunities, I tried to look a little bit beyond the Southeast. I had opportunities to go to some fine institutions closer to home, but felt that I wanted to take a little bit of an adventure and look further afield. And that led me on to Georgetown University, which at that time was a very international school and continues to be a very international program, predominantly because of its School of Foreign Service. So it really opened my eyes to a lot of the things that were going on around the world. And as I studied business and international business in undergraduate, it gave me a flavor for a lot of the opportunity that awaited both domestically and overseas. But I certainly had an interest in looking abroad as well, although I didn't realize how much of a vocational school that turned out to be. So I guess much like many other people in this type of a situation, especially schools in the U.S., you take on a little bit of student debt. I think it's a rite of passage at this point, or at least it was when I was growing up. And when I was looking at opportunities, I had started playing rugby at Georgetown, and I had some of my teammates that moved on to careers in Wall Street and are still there today. But that was really my first glimpse into what that life looked like and what those opportunities look like. So through our career center, I made some applications and ended up accepting a position at Chase Manhattan Bank, which is where I started my career in 1997 on the investment banking side of the business. But after several years and a lot of long hours and a lot of hard work, as one can probably imagine, I'm sure many people in the room can attest to, you start to think about what other opportunities might look like. You've saved a little bit and you've started to get past the student loans, and you start thinking about the future. But the conversations I had, frankly, with people here and with my parents back home did a great deal in terms of putting perspective around where I was, which was at a fairly early age, having an opportunity to see transactions and to meet really fascinating people and management teams from all over the world that were trying to do very interesting things from all aspects of business. Just gave me an opportunity and a lens that I never really would have had I not gotten this opportunity to go into banking to begin with. So after considering some options and thinking about school, I actually just ended up keeping my head down. And as luck would have it, I worked on some transactions overseas. I worked on the restructuring of a couple of companies overseas, and some new issue deals for the business I was working in. And that was in 2003, and they were looking at setting up a leveraged finance business in London. And so, again, the packaging and placement of high yield bonds and leveraged loans for corporate and private equity owned companies. And they wanted to have some boots on the ground to set up a business and a market presence there. And so, having done a few deals from New York, I was just one of those people that seemed to be in the fortunate position to make my way across the pond and help set that business up. And talk about a fantastic opportunity for a fairly young individual to go with this big umbrella that at the time it was Bank of America, and have the resources and the capabilities and the opportunity to help establish something was a tremendous learning experience. And it was also in a market that was much less developed versus where we were in the United States at that time. So getting to meet those players and just getting to move around the marketplace was really an interesting opportunity, and it actually led me to stay. It should have been a 12 to 18 month situation, but I decided to make the best of it and stay the course. And probably the biggest contributing factors to that was not only that it was on the early days, because who knows where things are going to evolve, but the fact that you're trying to see if there was an art of the possible to make things happen. And what I mean by that is you're looking across multiple jurisdictions, even though Europe is Europe and we all think of it as sort of the EU, but it's still 27 countries with distinct languages and different currencies and different laws and different regulations. And that was very intellectually challenging and exciting. And so it was something that I wanted to stay the course with and really get to understand better. And at the same time, frankly, just get to meet different people and understand the different cultures better and see what everybody was bringing to the table and how and the why and what I could gather from it. And so it just was something that continued to be enriching right up until we hit the financial crisis. And at that point in time, again, just trying to look to opportunities, I'd moved across to another bank where I helped set up a high yield capital markets business that I had the fortune of heading. And we saw ourselves in 2007 on the sort of on the precipice, and we were trying to make heads or tails of everything happening. And I was in the fortunate position with some very talented colleagues to have been able to move the risk that we had underwritten. So Matt mentioned the bridging of risk, and that's where we would use bank balance sheet to underwrite transactions before selling them to the market and making the difference. And we had sold we'd sold all the risk in my book by the first week of August of 2007. And I often joke, although it's not really a joke, and it definitely wasn't funny at the time, but I joked that that was the reason that I got to keep my job, was because we went into the crisis without much risk on our book. And that was a very crazy period in the marketplaces, and always happy to discuss that further, because that was certainly a crucible event for anybody that lived through it and was wondering whether monetary systems were even going to be functioning within the next 12 or 24 months. But we did get through to the other side. And when we got through to the other side, I felt that the business world, particularly banks in Europe, need to be operating from a more capital light position. And so I ended up at UBS, which was really leading with the advisory and the relationship sides of their business, and applying capital judiciously across its business lines in order to help its clients and turn profits and not just make loans to hold. And so this was a fascinating period of time, because it was, as the market was finding its footing, there was a sovereign debt crisis in 2011 in Europe, and we were still just trying to navigate the new world order under the guise of a lot more compliance and regulation and regulatory scrutiny. And so I guess that's a long way of saying that eventually I was fortunate enough to have looked back and found my career to be very fascinating. But then I had one or two clients that were calling, and having spent a career packaging, selling, analyzing, underwriting credits and risk opportunities, there was an opportunity to actually go and connect a little bit closer to the other side of that business and go work for a client. And so that's what led me to the buy side about a little over 8 years ago now. And it's been a tremendous opportunity. I mean, what we do now is probably similar in a lot of ways to what investment banks were doing back in the 1990s, which is using knowledge and using information to the best of our abilities to direct capital to the best opportunities and find the best return. So that combination of human capital and actual fiat capital are really the things that we had returned sort of to our roots and tried to put the customer, or at the client or the investor, or both, at the center of everything we do. And that's what's led me to where I am today, is really trading in the opportunity sets that I used to sell to these very clients.
Thank you, Boris.
So I think that was a fairly long-winded opening, Matt. I apologize.
You're good. It's good to get a background and kind of, because this is a different world for almost everyone that you're talking to, right? You're over in Europe, you're doing these leverage deals, you're doing a lot of different stuff that coming from Spartanburg, we don't know about this kind of stuff. So the people that fund the company, right, are going to be your limited partners, and you're going to have pension funds, you're going to have a whole bunch of host of different investors that come into the company. And I know that's not your wheelhouse, but at least that's how you guys kind of raise some of that capital that you will deploy eventually. But talk to us a little bit about the types of multinational companies that are coming to you, what their needs are, and then how you guys use data, how you use analytics. Like, how do you determine the risk and where to invest?
Sure. That's really at the center of everything that we do. And I think that's a great lead in to the different formats of capital that we manage. So I can say that we have everything from some listed vehicles to listed on stock exchanges to closed-end funds, and then to to some things in the middle where we manage large pools of capital for some of those big institutional investors that you manage on a single basis or as part of a commingled opportunity where they put money in pools together for us to manage together, which is that LPGP construct that you were mentioning. And our real opportunity set is alternative assets, which we categorize as sub-investment grade credit, as well as directly originated opportunities. So by that, what I mean is that on the liquid credit side, so the part of the business that I look after with my partner in Los Angeles, we really specialize in credit investment that has been packaged and sold by banks. So there's been an intermediate step. What we've done at our firm, and a number of our competitors have as well, is that we've gone into the business on the credit side of having people that go out and talk to clients and find opportunities for us to invest in. And those opportunities range from lower risk spectrum, although we think good risk reward, so better than investment grade opportunities, all the way down to the higher risk end of the spectrum, which we still think is good risk reward, but you're getting paid a lot more for it. And so we will directly originate and package those ourselves and hold and monitor them to harvest the returns for our investors. And that is anything from sort of the mid-single digits yield type of returns to the mid-teens type of returns. Then we also have a real estate business that does everything from debt to private equity focused on real estate. We have real assets, which also then includes infrastructure. And we have a private equity business that goes out and does leverage buyouts with pools of capital from their investors, but also has a special opportunities arm that will do things a little bit more in between sort of hybrid capital for companies or they might look at rescue opportunities for companies that might be struggling, but are certainly viable and just hitting a difficult point in their cycle. And so that's another thing that we tend to originate ourselves with our own teams. And then we also do secondaries and have insurance. And so these are newer businesses for us. But I bring all this up because the return spectrum goes anything from that mid-single digits to the mid-20s when you're looking at it across those pools. And when we're speaking to pensions and we're speaking to large insurance companies or sovereign wealth funds, or frankly, even in some cases to high net worth individuals and private banks, everything is about trying to match products to their needs. People value insight in terms of portfolio construction and ideas. There are some that want a single product. There are some that want a mix of products. There are some that are trying to match the duration of a portfolio, and therefore they're looking at sort of short to long term and how they can line that up. Some people don't ask us much at all in terms of what they're looking for from a construction perspective. They just are asking us to fill a specific need. Some people want us to asset allocate for them. So there's really a multitude of conversations that are going on with our different clients around the world. That takes a lot of time. It takes a lot of analysis. It takes a lot of input from a lot of our different teams. You're on the one hand balancing daily news flow and being in London, as an example, you have the benefit and the curse of GMT, which is you're sort of right in the middle of the time zone. So you have the overnight coming from Asia, and you're still catching them in the morning. To as you're hitting kind of lunchtime, then the US is getting up, and you have all that news flow going. And then as the day is sort of ending on our time, the US is coming back from lunch to really hit the afternoon. And so then that will continue into the evening, at which point Asia is starting to wake up again. So there's always this constant cycle. And how do we analyze that and package that in a consumable way for our investors to understand where they can get income, where they can put capital to work, and take the appropriate measure of risk for the needs that they're trying to service in order to get the best outcome or the best return. So there's a lot of variables going on there, but something that is not as prominent, and certainly now that we're in more of an inflationary period, Something that's not as prominent in the US is around the rest of the world, we've been in an environment of relatively unprecedented volume of negative yielding assets and negative yielding securities. So, I mean, it almost seems counterintuitive, but you are quite literally paying the government for them to borrow money from you. So, or there are corporates, there are investment grade companies, and at some point there were even high yield bond companies, double B credits that were actually borrowing at negative rates. And when you were a pension fund, using them as an example, 15 years ago, to match the liabilities, they comfortably were modeling a 6 to 8% return in their portfolios because the risk-free rate was 5 to 6%, generally speaking. So they were being fairly conservative and they thought that they could meet their needs. Now, that 5 to 6% or 6 to 8%, for at least for a good while there, looked like quite a stretch, because government bonds, at least in Europe as an example, until recently were kind of minus 50 basis points, and short-term rates were even lower. And if you put your cash on deposit at a large institution or a central bank, you would actually be paying. You'd be paying between 50 and 100 basis points for an institution to hold your cash. So all of a sudden you're fighting cash drag, at which point it means you need to have your cash completely deployed. So you're taking a different level of risk than other people might actually have envisioned when they were first starting out on this journey of balancing these portfolios. So these are the kinds of things that we are getting moving around and coming at us from all sides and from all jurisdictions. And we're trying to work seamlessly across the 2,100 employees and 32 offices we have around the world to service the clients, to match product sets to the needs that are confronting them.
So Boris, this is fascinating. I mean, a lot of you kind of have to wear two heads in a way, two hats, because you have to not only one, be very creative in terms of listening to clients, what their needs are, what the return they're looking for, the portfolio mix, but you also have to go out and hunt stuff that you can go repackage and sell off in a way, correct? And so you take the creative side, plus you have the analytical side component to it. Is that what makes a good individual in this industry, like to enter in, to have those both mindsets, to be able to shift quickly? Or for our students, like if they wanted to enter this finance world that you're in, what's the best approach in your opinion?
Well, I think that being nimble and being agile, like these are all, the fancy words that I think people throw around a lot. So I'll try and shy away from them. But I mean, I saw some of the questions that were just coming through in the chat, and so someone said, it's like, how much would you balance for, say, common sense investing, et cetera, et cetera. I think a lot of it comes down to basic individual qualities, like common sense or like collaborative thinking. When we are being thrown different situations from different investors and different cultures and different parts of the world that have different regulatory needs and capital concerns and perhaps even capital constraints, you do have to always be putting yourself in that person's shoes and thinking, what are they actually trying to achieve, right? Let's strip away all the noise and the nonsense, and without getting too far over our skis and saying, well, they just want to make a lot of money without taking any risk, because that's too obvious of an answer. These are sophisticated people and they're sophisticated investors, but they're nervous, right? They're entrusting you with capital that's important to them. And a lot of times, like I mentioned, insurance and pensions, this is the lifeblood for a lot of people for the tail end of their careers and the rest of their lives going on to the sunset. And that's a big responsibility. So they're not going to give it to you lightly, and you certainly shouldn't take it lightly. So I think that having a balance between being open-minded, having good common sense, being able to be, let's say, empathetic, taking ego out of a situation just to analyze the facts as they are and try and come up with the best solution whether it includes you or not, are going to be the hallmarks of proper advice. And if you're doing those things, then your customers and your clients are going to continue to seek your advice, because you know that, or they're going to know that they are at the center of your thinking and you are not at the center of your thinking. So that is more of a customer centric point of view. When it comes down to the individual and breaking into this industry or thinking through this industry, it's a great question, because when I first started out, which is now donkey's years ago, sadly, and got some of the gray hair now to show for it, there was very much a star culture. Whether it was banking, asset management, hedge funds, private equity, there were individuals whose names were known by everybody within the industry. And frankly, the fault of that was that people realized that these firms were living and dying by some of those individuals. And a lot of capital was being made or lost due to those individuals. And that is not a sustainable model. That's not the way to work. So at the same time, being collaborative and being in a team environment and being able to challenge each other is extremely important. But you also need to make sure that you have your own voice and that you have the confidence to put your views forward, not because you need to be heard, because a lot of people will make that mistake and they just think that they need to contribute something so they will speak. But it's not necessarily that. If you have something valid to contribute, or if you have a question that you think is going to take things to a different level, or frankly, sometimes if you just have a question because you simply don't understand what someone is saying, it's not worrying about that. It's your goal is to be trying to get to the right answer. And if you're going in with a mindset that you can work in a team, but you have enough confidence to realize that there are going to be moments that you're going to be the one carrying that team forward, then you have every ability that you need to do well in this business. I mean, and this is, of course, assuming that analytical abilities are reasonably sound as well. But those softer skills are actually what takes people from sort of a mid-level career to a, to a higher end of their career.
Thank you, Boris. One of the other questions we have really is, the markets, as you mentioned earlier, are changing rapidly. I mean, you're back in the US this week, maybe for a week or so. You're probably looking around at housing prices and laughing, right? You see inflation, you see what's going on in Russia, full stop. What are your clients thinking right now in terms of where the market might be headed, where things are headed in the future?
Sure. The macro discussion is absolutely top of mind to everyone, not only from a business perspective, but even a personal perspective. And we debate these just amongst ourselves because we want to think about how we're supposed to be positioning for our clients' interests, but just even for us, just even personally. I mean, I think it's something that is on everyone's list of to-dos in terms of trying to navigate the current environment. I wish I could say that the housing prices here, which you're right, they seem to be elevated to say the least, but they're pretty elevated in a lot of parts of the world. And there's a couple of factors that we've seen trickling through the economy for quite some time. And it was post-financial crisis where you had a lot of monetary and fiscal response to get us out of that, which I think, again, for those that may or may not have been sitting on a trading floor in the heat of the moment, it was a pretty incredible moment in time that could have had massive repercussions. And so I think that the response was merited. And what happened thereafter was that any time that there happened to be some potential for a slowdown, or there was potential, economic loss facing someone from the political theater, then you could see that there would be pressure, and that monetary policy started to become a tool that was used quite a bit. And frankly, and then markets started positioning against that, or starting to take that into account as one of their analytical tools. So when we've been looking at all of that, we were frankly, just pretty surprised that it's continued as long as it has. And the negative rate environment only looked like it was going to continue getting worse until we got to COVID. And COVID really threw a curveball to everyone. I think one of the underlying theses that we tried to stick to, though, during that time is that this event, and I mean economically, not the virus itself, but the economic event of locking down and shutting down economies was man-made. And so the way out of that was also going to have to be man-made, so that the people that turned the car engine off were going to need to turn the car engine back on. And they couldn't bankrupt half the world in the meantime because it was a voluntary choice. So there was going to have to be support during the period of time and ample support on the way out. As a result of that, there seemed to be an inevitable bout of inflationary pressure. And core inflation is something that has been, I think, relatively moderated, and companies have been able to pass those costs along. But again, we look at the why, and the why being that you had people, not everywhere, but broadly speaking, with lower than usual activity, receiving still fair amounts of income and cash for 2 years. And so savings rates around the world were back to, very high to almost unprecedented levels. And then coming out of this economic slowdown, you have this tailwind of reopening that has put through huge growth prospects. I mean, living in the UK and seeing that the UK was supposed to be the fastest growing economy in the world was a bit of a shock to the system, but everybody could believe it. And I can attest to it because you can see the economic activity there is massive. That being said, historically speaking, the UK and Europe, if you look over the last 10 years, if you're running at 1% to 2% growth, that's pretty good. It's not great for equity prospects, but for credit, it's great. That means the cash flow is running and it's going to keep paying you back. So that's fine. So when it was at 4.5%, 5% or 6%, all of a sudden, these were just, astronomical numbers. And why do I bring that up? Because that is a massive cushion for a war breaking out or rising raw material prices or inflationary and wage inflation pressure, which until through the end of last year, as I mentioned before, we've seen our companies, generally speaking, around the world have been able to pass that on to consumers, but eventually that's not going to work as well. And there's going to be some margin pressure. So we've been watching that really closely in this period of time. We were positioning against it toward the end of last year, and that turned out to be beneficial, especially with the geopolitical tension in the east of Europe, exacerbating some of the raw material and energy costs that we've seen coming through the companies. So the next questions really, though, are around, or what we're looking forward to is, growth will moderate, but it'll still be there because of this cushion we had. So there's this positive halo, unbelievably, that COVID has created to give us some cushion to deal with these spikes in prices to where it won't be terribly painful. And that's why you see central banks still staying hawkish. They're still going to focus on trying to tame inflation and right size rates and balance sheets, as opposed to react again. Cynically, you would think that they're also doing that in a response so that they can have some room to maneuver in case things actually get worse on a geopolitical side, but it doesn't seem that is necessarily going to be the case. So from that positioning perspective, or just from thinking about it, for us, it was still information services, technology, healthcare names, laboratory companies, those types of sectors have seemed pretty defensive and pretty resilient. And we've tended to focus on those over the last several months. And now we're seeing opportunities to move back down into riskier stuff and into things that are a little bit more cyclical, because the expectations around companies defaulting and default rates, while they will move up, they're moving off of very, very low levels. Some of the markets that we invest in are currently running at 0% default rates versus 10-year averages in the 2.5% to 3%. So they have a long way to go before we even mean revert from that perspective. So there's a lot of moving parts at the moment, but I don't think it's quite as scary as long as people keep a cool head. But then again, I think who keeps a cool head most of the time? We think we all wish we would.
Interesting, raising rates just to create the buffer for the future totally makes sense. If they need it. Talked a little bit about, the impact of Brexit, having been in London during all that time, and the whole issue now that we have with supply chain, because, that's an output also of Brexit. You have supply chain issues, not just over in the UK, but all over the world. How has that impacted the business? Because I know, you're going to focus more on the pharmaceutical, the other areas that COVID impacted that are resilient. But as you dig deeper down, is it really the supply chain? Is it the suppliers? Like, what do you see happening in that landscape that can unlock future capital and returns for your clients?
Well, so supply chain issues were definitely something that were brewing. There was a little bit around Brexit, although that seemed to sort itself out reasonably well. I mean, there's still going to be some fits and starts, especially around the UK. We started tracking components. I think the most convoluted and the easiest to analyze and try to use as an example is the auto industry and auto parts. And to create, like, to basically assemble a drivetrain, we track, like, one of the parts had to cross the channel 4 times back and forth in this journey to becoming a complete drivetrain, and then installed into an automobile before it was shipped across. So trying to understand, like, the logistics of that. First of all, I can't imagine why I would need to make 4 trips, but that somebody smarter than me has figured that out. But that was something that I think it was coming together a little bit well, albeit with some friction and some taxes and duties that were unexpected. Away from that, though, yes, I mean, everything is starting to be hit by supply chain. Part of it is from labor, the labor intensity, and frankly, like the shortage of labor that we're seeing across the developed markets and the developed world. I mean, it's very interesting to come out of a pandemic and then come out of a situation like this and still be, grinding down on unemployment to levels not seen since the 50s. So that's, that's certainly going to have an impact. But raw material costs and transportation costs are the next limbs of that. And it is, again, around everything from the food industries and foodstuffs, like wheat, corn, some of those commodities that are increasing in prices. They're starting to move away to higher bidders, or people are starting to look for alternative sources. And when people start looking for alternate sources for materials or for components, then that creates a second order of supply chain strain, right? Because now they're looking to reorganize and recut their supply chains. So we've seen a lot of it around, and I think everybody has, again, around the auto industry and around technology. There's things like neon gas that goes into semiconductors, and apparently a lot of it is mined in the Ukraine. So that's put a little bit of a pinch points on semiconductors yet again, and then chip technology going into pretty much everything that we do. So there are certainly elements of it that are pervasive, that stem from a few root causes. But where does that go, I think, is the question that we've all been debating. And when you think about sort of way back when, the whole concept of globalization, while it is rooted in economics predominantly, and people with, that are better making something and they can do a lot more than they need so they can sell the excess at a competitive price versus someone that can't. But there was also post-war, I mean, the Second World War, a little bit of a cultural exportation as well, in terms of giving people an opportunity to learn a little bit more about each other, realize that it's better to live in some sort of a harmony. And then eventually, as time moves on and as technology starts to flourish, the globalization, like the last order of it, is actually relocalizing a lot of industry and a lot of opportunity, a lot of demand, save those raw materials that simply are sourced in one part of the world versus the other. And so this has been an interesting few years between the geopolitics as well as COVID, because there's a lot of focus again on actually onshoring businesses or bringing expertise back, using technology to solve the shortfalls that have made things less competitive. As we see in Europe in particular, Germany made a big misstep by starting to shut down and decommission nuclear reactors after Fukushima, and go heavier into their dependence on Russian-sourced gas and oil. As a result, now they're trying to say, okay, we're going to need to get off of that. And even the Greens, who've been against nuclear since the 60s, are starting to say, well, actually, we think we probably need a balance so that we're not over-dependent on any source of energy. And so all of that is leading to a tremendous amount of innovation, a tremendous amount of opportunity, and people are starting to rethink the world in a new way. And I think that's a massive opportunity that people can go out and try and capture in the business world now.
Do you think the pendulum maybe have swung too far in either direction in prior history? When you think about what you just said, right? Semiconductors, battery technology, for a long time, we didn't have that here in the States. And now you have Intel putting $3 billion in Ohio to build a plant. You got a lot of initiatives on green energy through legislation. Are we swinging too far in one direction, or is it a kind of a knee-jerk reaction because of all the issues we're having geopolitically? Or do you think we're headed in that right direction and that we need to bring that stuff back onshore?
Well, I think that you put it well, that it's a pendulum. And candidly, or at least from my own opinion, probably not expressing the views of Ares management, but at least me personally, it's been difficult to reconcile cutting off the lifeline or source of capital to industries and businesses that need to continue operating during any sort of a transition. And over-reliance on anything, I don't necessarily think is a great idea. So you take, as you mentioned, sort of, electric vehicles as an example. So it's a great idea, sure, but it still needs a lot of electricity. Then there's still a lot of lithium ion that needs to be mined. There's all kinds of things that are going on, and components that are going in that need to be sourced from various parts of the world. And there's still mining and shipping. There's a lot that goes into that. These products that go into these vehicles have a finite lifespan. So in several years, you're going to, if you're running whatever, 77 million autos a year as an example of an annual, sort of an average annual output, in 7 years, there's going to be another 70 odd million vehicles, but you're also going to need another 70 million batteries. So is perhaps some mix of lithium ion battery technology plus hydrogen a better answer? Sure. In the meantime, though, do you still need to keep the lights on? Are you going to cause massive problems for a lot of other people? You are. So there needs to be a more balanced view in terms of what we go forward with. And I just bring that up because, as you said, building a new plant or moving to a new infrastructure or new technology, hopefully people are not just putting all their eggs in the next basket without realizing that it's not 100% perfect yet, and that there might be something better or simpler that we can develop in the meantime. If it's a multitude of options, so that, some people, for the same cost, so you have to cost equal everything. But if some people are still running on gas powered cars, while some people have electric, and some people have hydrogen, as we're slowly phasing through things, then it might not be the worst thing in the world to have a few different options in case you run out of something along the way and you need to shift to another. Because if you don't do that, then you can cause all kinds of problems. You can cause real shortages of anything and everything that you could think of that can lead to some pretty catastrophic results for the people on the ground. Yeah. So sustainable is key. I mean, we talk a lot about ESG these days. I know people hear it a lot more in the US. That's been a fact of life in Europe for a really long time now. But when it comes to credit investment, our view has always been that if you're not thinking about, the environmental impact or the way a company is governed or the social impacts or the sustainable impacts, that's all part and parcel with the longevity of a business, which is at the heart of credit investment. So if you haven't been thinking about these things, then you've probably been missing a trick. It's more about how are you translating that, and how are you creating the KPIs to help other people understand what you're trying to express with your views and with your investments.
Mhm.
And in doing so, that is hopefully what will be the influence that can help shape the markets going forward.
And
so I think the balance is key.
Yeah, and because you look at the government incentives pushing certain directives and how far that swings the pendulum in one direction. Really good point. You brought up another point about employment. Obviously crazy low right now. We actually you look at things at a macro level. We look at here in Greenville, Spartanburg at a micro level. We have a lot of automotive companies. We have a lot of manufacturing here. And we actually, Dr. Pickett and I were fortunate enough to be in a meeting earlier this week with a number of CEOs from this industries, and the issues they have with bringing on workforce and workforce development. Do you see, especially being in the UK, I've heard stories of immigration policies. Does that need to change in order for these companies or countries and companies to bring things onshore to allow for that type of growth, especially in the supply chain issues? Do you see that happening in the UK as well as happening over here in the future?
Well, I think the heart of that is around some of the demographic challenges that we're all going to be facing in the West and in large parts of the East. I mean, even China is going to be facing this as well because of their one child policy. Is that we have a rapidly aging population. I mean, I don't know if you have looked much, but I pay a little bit of attention to Japan around this because they're in a real situation where, I might be getting this wrong by a bit, but if it's not 2050, then it's by the end of the century, where their population is projected to shrink to about 80 million, and it peaked around 130.
Yep.
And when you think of that in terms of then labor supply, you have this, how should I put this, incongruous point where you have a lot of people to support and just not enough people to work. And so usually growth comes with younger populations or with growing younger populations. And right now that's in more of the emerging markets than it is in the Western and developed markets. There's a little bit more of a balancing act in our parts of the world, but that historically was solved then by you allow movement of people to help solve that. There's a lot of people that want to come to another place, and my parents are two of those people because they see an opportunity and they can they believe that they can provide a positive contribution and they want to work hard to achieve it. Actually, I guess I'm an immigrant from the eyes of the UK, so
yeah,
hopefully I'm contributing taxes and a positive, being a positive contribution as well. And you have to be able to allow for that. And I guess, setting a scope that people coming in from other places to help alleviate those problems is bad is not going to help, because at some point in time, you're going to become uncompetitive. And you can see some economies, I don't want to pick on any places, so I won't name them, but you can see some places where these demographic issues are starting to bite, and these policies that are a bit protectionist are really starting to wear down the economies, and the balances are moving in the wrong direction. Debt is moving up, and so they're just stagnant, and they're going to stay that way until there is something done about it. So I think it's fair to bring up the immigration point.
Yeah, it was a funny thing that someone shared with us, and this is for the folks here at Sidewall Pizza, right? Work part-time, $1,000 sign-on bonus. I mean, there are essentially jobs that need to be done that no one is either willing to do, or because unemployment is so low, they don't need to do. So it's fascinating to see what you see on your side versus what we see here on the ground here in Greenville, Spartanburg. So bringing back one last point, with the time that we have left, you grew up in Spartanburg, we're all here. If we want to break out and kind of follow that path that you did, whether it be in finance or internationally, what's the advice that you would give to an MBA student coming out of this program here soon? What paths, what what trajectory, what things do they need to do to separate themselves, to allow themselves to have these opportunities in your worldview?
Sure. I think that the world has obviously changed a lot since I kind of went down this, and I probably did a lot more stumbling into things than actually strategic planning and tactical thinking. But what I would say today is that it is a very competitive world out there, and that there's a lot of attributes that are currently underutilized and undervalued, that are becoming more so because the dynamics of the world is changing with technology in particular, and the interconnectedness is getting more and more acute, even though we're in a point in time where people are starting to question the validity of globalization and global connection. I did feel like perhaps that will express itself in some ways, but not in others. So for those people that are on the ground, having a viewpoint as to, well, mapping out a universe as to what are the companies, what are the businesses, fine. Which ones are growing and are more agnostic to geography is another thing. The world has changed from it's all concentrated in New York to we have offices opening up all over the place. Everybody, I think, even a lot of people from New York that have always been there, opening in Florida and Texas and all over the country. So they're starting to move around as well. But I wouldn't just look at that as the opportunity set in terms of going back into an industry that's necessarily been there for a long time and is a little bit staid. I think it's what can you bring to the table? I mean, you certainly are going to be eager, and you work hard, and you have good analytical skills and a good mindset. It's what else are you going to bring with you that really, I guess, shows the dedication and the drive and the want to, or the desire to make a change. People are looking to businesses these days to do more than just that monoline of what they've always done. I mean, as a financial institution, that's certainly first and foremost, but we are trying to make an impact in a lot of different ways. We're trying to innovate and evolve our technology in a lot of new ways and use everything from third parties to homegrown systems. And so the scope of the people that we're looking for is definitely changed over the years. And I don't think that, the model of you look at four different, you look at four schools and it's like, okay, this is the crop that we're looking at. There's so much value in looking more broadly because you have this fantastic sets of people from all over the country and all over the world that are bringing different views together and have different backgrounds. So just relying on those core strengths and some of the things we talked about earlier, I think is definitely the way forward. Mapping it, making it easier for yourself, mapping it and saying, right, like this is the area I'd like to go. These are the 10 best companies. Don't be shy to reach out. That's something that definitely didn't exist when I was coming up. I have, frankly, even university students now, amazingly, that they will send me a note on LinkedIn and just say, I've looked at what you've done and I would just like 30 minutes if you have time to ask you some questions and get your perspective. And I'm always happy to do things like that because I think anybody that's taking the time to do that, I the least I can do, even though time is very valuable, and the least I can do is try and carve out any kind of time to give somebody that shows that initiative an opportunity just to be heard, and to give a little bit of advice. And if there's something that I can do to help, then I'm certainly going to try. So I would certainly encourage people to reach out and do all the networking they can, and just be self-confident. Have belief and work very hard.
Awesome, Boris. Thank you so much. And for those of you that are on today, if you do want to reach out to Boris, feel free to contact me and I can make that introduction for you and talk through what the needs are. I also want to give a thank you also to Sam Reed for making this connection for us. Incredible to have you, Boris, and to have someone from Spartanburg who's gone on to do just tremendous things and being a part of the industry and sharing that knowledge with Clemson and our MBA students. So thank you again for your time. Enjoy your time back in the States with family. And I'm sure I'll see you across the pond here soon too. So everybody, enjoy the rest of your residency weekend. And thank you so much, Boris. Have a great day.
Thank you, everyone.
Thanks
a
you,
lot,
Boris.
Matt.